Hello, this is Brian Shannon from AlphaTrends.net. Today is Wednesday, the 30th of April, 2008, and the market's closed where the Federal Reserve cut interest rates once again today by 25 basis points. And initially, we got that market volatility that we typically see right after a Fed meeting. It looked like the market wanted to break past that 140 level, and it did break past it. But as I was saying yesterday, and I often like to say, is it's not the breaking of a resistance or support level that really matters, but what's the subsequent action? Can the market hold on to those gains? And clearly, a lot of people were looking at this 140 level as important. We saw the volume surge on the break past there, and there's nothing wrong with getting long in there. But again, you always have to have a backup plan that accounts for what could go wrong. And what could go wrong is from failed moves often come fast moves. As the market broke down through that and then back through this VWAP here, you can see this is where the sellers really took back control below this 139.80 level when it did this real large bar below that declining VWAP. And that's where the sellers really took control of this market for the day. So if you're wrong initially, there's nothing wrong with that. But to stay wrong and stay long, that's just stupid, basically. If you're a trader, if you're an investor who's investing for some other reason, personally, I don't see it here on the chart right now, as we are below this declining trend line, of course, in the 200-day moving average. But more importantly, is the 140 level that we've been focusing on. The last couple days I've been saying that the market seemed like it was getting tired up in here and that we wanted to be careful. There were no bearish signs, but it just was really just seemed like the market was, again, tired up here. And we had it at the high end of the recent, larger range that we've seen. And that makes it, in a risky position for establishing new longs. Because, again, from failed moves often come fast moves. Now, looking at the 30-minute time frame, I was comparing this market 2 days ago to this action over in here. And basically, this looked very similar. Now it's possible that we might be setting up a similar downward move. Maybe it takes it down towards this level in here. That's too far away to really consider. So what we want to do is, again, look at some of the more relevant things that we've been looking at recently, such as on the 30-minute time frame, this trend line. You can see that has been broken, and we also closed below this low here at about 138.50. Now, we're close enough to it that perhaps the market begins to stabilize in here, but I think that more aggressive traders definitely want to be more, sidelines to maybe thinking about short positions here in the S&P 500 at least. For now, if the market can, climb back above that 140.5 level, then perhaps the buyers regain control and it can push its way back up to some of these other levels, such as the 200-day moving average and the December lows that are up around that 144 level or so. So looking at this, here's our potential levels of support going forward, 138, and of course the more important level is going to be that 137. So we could head back down towards that level. We saw a big volume on this sell-off here, obviously. Look at these 30-minute bars in here of volume, as they were clearly bigger than almost any other volume period since March 27th, just to show the significance of that. Looking at an hourly time frame, we've got maybe this as a trend line in here, but again, let's stay focused instead for now on 138. And if that fails to hold, then this market has the potential to get back down towards that 137 level. The IWM, the Russell 2000, of course, this market has been kind of stuck underneath this 73 level. And like I said yesterday, it's at the high end of the range, but at that $73 level, and that you want to be careful in here. And we would be looking for any pullback in this market to hopefully hold near that 71.25 to 71 level. You'd see we closed just basically at these lows right here. So this seems to have taken on a little bit of added significance, about 71.30 or so. We've got this trend line in here on the 30-minute time frame that hasn't been broken. So that remains bullish. That's at about 71 bucks a share, and realistically, it's probably 71 to 60 or to $70.80, 70, 80 to $71 a share. That's where we have the potential for support. Now, just because we saw this market break down today and we have this lower high and now a lower low, doesn't mean the market will give up all these gains completely. It usually takes a couple days for the market to digest the activity of the Federal Reserve. A lot of money gets moved around based on the decision of the Fed, and realistically, for a short-term trader, it just provides tremendous volatility. That if you're disciplined and skilled, then it becomes a great trading environment. The XLF, this market again. Here's that trend line that we've been monitoring. The market remains above that. It also remains above the 10, 20, and 50-day moving average. And it's good to see that the 10 and 20-day moving average are now heading higher, and the 50-day is flattened out. So it makes it a little bit more likely that we may still see a move higher above 2750 is what it's going to take, though. So it looks as though it's setting up more, here we've had the downward move. Now it's turning more neutral. What it takes to get it bullish is a move above 2750. So there's no reason to buy the financials in here. If you're anticipating that move, there's nothing wrong with anticipating a movement above that 2750 for thinking that that's the place to get long, or even 20 right up in here. You can anticipate, but wait for price action to confirm before you participate. If you're if you're Steve Cohen, then and you've got billions of dollars, maybe you start buying in here because he can't buy $100 million position as quick as we can buy our several thousand shares or whatever it is you trade. The point is anticipate, but wait for price action to confirm before you actually participate in the action. So this market, we want to keep an eye again on this 26.20 level, $26, basically 26 down to 26.20 down to $26 a share is our potential level of support for this market. Below that, of course, we've got this little level right here, and then the 24.40. Now on the Qs, the NASDAQ 100 was down 39 cents, or about 82 cents, and it continues to kind of find some indecisive action, I guess you would call it, near that trend line, and it came up very close to the declining 200-day moving average in here. This market is at a very pivotal point here from a longer-term perspective. When we look at this prior support, has the potential to act as resistance, and this level is further validated as potential resistance because it's where we see the declining 200-day moving average. And a lot of the institutions think that bulls live above the above the 200-day moving average, and bears live below the 200-day moving average. It's the longer-term perspective. Of course, the way I look at the daily time frame is, innocent till proven guilty with a 50-day moving average. But we want to always, when we have conflicting signals from a larger time frame, we want to be aware that this longer-term trend has the power, the ability to power this market back lower. So that we're still, not out of the woods just because we have a bullish-looking daily chart. This trend line that we've been monitoring for the last week and a half or so has been broken. That's not a good sign. We see that the market broke out here, but then failed to hold. From failed moves often come fast moves, similar again to this move over here. So you want to be basically on high alert for further potential downside. 46.50 is going to be important, as is $46 a share. Those are potential levels of support for this market if it continues lower.